What I'm about to reveal will fundamentally change how you think about the housing crisis, home ownership, and the American dream. The reason you can't afford to buy a house isn't because of natural market forces or economic cycles. It's because the housing market has been deliberately rigged by corporations, investors, and government policies designed to transform Americans from homeowners into permanent renters who pay tribute to a new class of digital landlords. This isn't about supply and demand or interest rates or construction costs. This is about a coordinated effort by Wall Street firms, private equity companies, and government agencies to eliminate home ownership for ordinary Americans while creating a rental economy that generates unlimited profits for institutional investors who now own millions of homes that should belong to American families. By the time I'm finished explaining how this system actually works, you'll understand why home ownership rates have plummeted among young Americans, and why the housing crisis isn't a crisis at all. It's the successful implementation of a business model designed to keep you renting forever while enriching corporate landlords who treat housing like a commodity rather than a basic human need. Let me start with Jennifer Walsh, a 29-year-old nurse from Phoenix, Arizona, who has been trying to buy her first home since 2019. Jennifer makes $75,000 per year, has excellent credit, and has managed to save $40,000 for a down payment despite paying $1,800 per month in rent for a one-bedroom apartment in 2019. Jennifer was pre-approved for a $300,000 mortgage and began looking at starter homes in decent neighborhoods, but every house she was interested in received multiple offers within hours of listing, often for 20 to 30% above asking price, all cash, with no inspection contingencies. Jennifer couldn't compete with these offers because she needed a mortgage and wanted to inspect any home before buying it. After 6 months of losing bid after bid, she gave up and continued renting, hoping the market would calm down. But the market didn't calm down, it got worse. By 2021, the same houses Jennifer had been looking at for $300,000 were selling for $450,000. By 2023, those houses were worth over $500,000, and Jennifer's rent had increased to $2,400 per month for the same apartment. Despite earning more money and saving diligently, Jennifer is now further from homeownership than when she started looking. The houses she could afford in 2019 are now completely out of reach, and her rent increases have made it harder to save money for an ever-increasing down payment requirement. What Jennifer doesn't understand is that she wasn't competing with other families trying to buy homes. She was competing with Wall Street firms that can buy houses instantly with cash, treat losses as tax write-offs, and hold properties indefinitely while waiting for values to appreciate. Jennifer's story is being repeated millions of times across America, but most people don't realize that their housing struggles aren't the result of market forces. They're the result of deliberate policies and investment strategies designed to eliminate homeownership as an option for ordinary Americans. The transformation of American housing from a pathway to wealth building into a rental extraction system began in earnest after the 2008 financial crisis, when millions of foreclosed homes were sold at discount prices to investors rather than being made available to families who wanted to buy them. Instead of helping families purchase these foreclosed properties, government agencies like Fannie Mae and Freddie Mac sold entire portfolios of homes to Wall Street firms and private equity companies, giving institutional investors a massive head start in accumulating residential real estate. BlackRock, the world's largest asset management the company, has become the symbol of corporate homeownership, but they're just one player in a much larger system. Invitation Homes, American Homes for Rent, Progress Residential, and dozens of other companies now own hundreds of thousands of single-family homes that were previously owned by American families. These companies didn't just buy a few properties. As investments, they bought entire neighborhoods, sometimes purchasing every available home in specific zip codes to create rental monopolies, where families have no choice but to rent from corporate landlords. The scale of this institutional buying is staggering. In some markets, investors now purchase over 30% of all available homes, making it mathematically impossible for local families to compete. When investors can pay cash immediately and waive all contingencies, traditional home buyers who need mortgages and inspections simply cannot win bidding wars. But the corporate takeover of American housing goes beyond just outbidding families. These companies use sophisticated algorithms and data analysis to identify undervalued properties, target specific neighborhoods for acquisition, and coordinate buying strategies that maximize their market control while minimizing opportunities for individual ownership. The investment strategy isn't primarily about property appreciation. It's about creating a permanent rental income stream from families who have no alternative housing options. Unlike traditional landlords who might sell properties when values increase, these institutional investors are designed to hold properties indefinitely and extract maximum rental income over decades. This creates what economists call housing financialization, where homes are treated as financial instruments rather than places for families to live. The goal isn't to provide housing, it's to create investment returns by controlling housing supply and keeping rental prices as high as the market will bear. The government policies that enable this transformation reveal how deliberately the system has been designed to favor investors over families. Tax policies give investors significant advantages that aren't available to homeowners, including depreciation deductions, mortgage interest deductions on unlimited properties, and the ability to defer capital gains taxes indefinitely through property exchanges. Meanwhile, families trying to buy homes face increasingly restrictive lending requirements, higher down payment demands, and mortgage qualification standards that eliminate many potential buyers from the market. The same government agencies that help investors buy homes in bulk make it harder for families to qualify for single home purchases. Zoning laws and development restrictions artificially limit the housing supply in most American cities, creating scarcity that drives up prices and benefits existing property owners at the expense of potential new homeowners. These policies aren't accidents, they're deliberately maintained by local governments, influenced by real estate interests who profit from housing scarcity. The construction industry has also been corrupted by this system, with builders increasingly focused on luxury developments and rental properties rather than affordable starter homes for first-time buyers. When builders do construct affordable housing, they often sell entire developments to institutional investors rather than individual families. That this isn't happening because building affordable homes isn't profitable, it's happening because the financial system rewards institutional ownership over individual ownership, and builders can make more predictable profits selling to corporate buyers than to individual families. The mortgage industry plays a crucial role in maintaining this system by making home loans increasingly difficult and expensive for ordinary buyers while facilitating bulk purchases by institutional investors. Banks can make more money on commercial loans to investment companies than on individual mortgages, creating incentives to favor institutional buyers. The appraisal process has also been manipulated to support this system. Properties sold to investors often appraise at higher values than similar properties sold to families, creating artificial price inflation that makes homes even less affordable for individual buyers while justifying higher returns for institutional investors. But perhaps the most insidious aspect of the engineered housing crisis is how it's been disguised as natural market dynamics rather than deliberate policy choices. The media consistently frames rising home prices as inevitable results of supply and demand rather than the predictable outcomes of policies designed to favor investors over families. This narrative obscures the reality that housing affordability was deliberately destroyed through coordinated actions by financial institutions, government agencies, and real estate industry players who profit from keeping Americans as permanent renters. The rental economy that has replaced homeownership represents a fundamental shift in American economic structure, from a system where families could build wealth through property ownership to a system where families pay tribute to corporate landlords while building wealth for institutional investors. This wealth transfer is massive and ongoing. Every rent payment represents money that could have been building equity for American families but instead flows to Wall Street firms and private equity companies. Over a typical renter's lifetime, this represents hundreds of thousands of dollars in wealth transfer from families to investors. The psychological and social impacts of eliminating homeownership extend far beyond just financial costs. Homeownership has historically provided Americans with stability, community roots, and a stake in local governance that rental housing cannot replicate. When families can't buy homes, they can't put down roots in communities, invest in local schools and services, or build the kind of stable neighborhoods that have historically characterized American society. The result is a more transient, less connected population that has less stake in local democratic institutions. The elimination of homeownership also undermines family formation and wealth transmission across generations. When parents can't build equity through homeownership, they can't help their children with down payments or leave real estate assets to future generations. This creates what sociologists call downward mobility, where each generation becomes less financially secure than the previous one, despite working just as hard and following the same rules that enabled previous generations to build wealth through homeownership. The international implications of America's housing financialization are also concerning, as foreign investors and sovereign wealth funds use American real estate as a safe haven for capital while displacing American families from homeownership opportunities. Chinese investors, Middle Eastern sovereign wealth funds, and European institutional investors now own significant portions of American residential real estate, creating a situation where American families pay rent to foreign entities while being excluded from ownership in their own country. This represents a form of economic colonization where domestic housing becomes an investment vehicle for foreign capital rather than a pathway to wealth building for American families. The profits from American real estate flow out of the country while American families struggle to afford basic housing. But the housing crisis affects different communities unequally, with deliberate policies that concentrate institutional ownership in specific neighborhoods and demographic areas. Minority communities, first-time buyers, and working-class families face the greatest barriers to homeownership, while wealthy areas often remain accessible to individual buyers. This geographic and demographic targeting reveals how the housing crisis serves broader goals of social control and wealth concentration. By eliminating homeownership opportunities in specific communities, the system ensures that wealth building remains concentrated among existing property owners, while new wealth creation becomes impossible for targeted populations. The sector has also been co-opted into this system, with companies like Zillow, Redfin, and others using their market platforms to facilitate institutional buying while making it harder for individual families to find and purchase affordable homes. These platforms provide institutional investors with data advantages and buying opportunities that aren't available to individual families, essentially turning technology that should democratize home buying into tools that favor corporate ownership over individual ownership. The rental management industry has grown alongside institutional ownership to create professional systems for extracting maximum rent from families while providing minimal service and maintenance. These companies use algorithms to optimize rent increases, minimize repair costs, and maximize profits from families who have no alternative housing options. The result is rental housing that costs more while providing less value than the homeownership. It replaced creating worse outcomes for families while generating better returns for investors. But what makes the engineered housing crisis particularly insidious is how it's presented as beneficial progress rather than wealth extraction. Corporate landlords market their services as providing flexibility and convenience, while eliminating the burdens of home ownership. This marketing narrative obscures the reality that renting provides less stability, no wealth building, and no control over housing costs. While homeownership historically provided families with financial security, stable housing costs, and community investment opportunities, the flexibility argument is particularly deceptive because most renters aren't choosing flexibility. They're being forced into rental situations because homeownership has been made artificially unaffordable through deliberate policy choices and market manipulation. However, there are still strategies that individuals and communities can use to resist the housing financialization system and create pathways to homeownership, though success requires understanding how the system works and finding ways to work around its barriers. Community land trusts, cooperative ownership models, and local first-time buyer programs can provide alternatives to the corporate-dominated housing market. Though these programs often face opposition from real estate interests who profit from the current system, political action to change zoning laws, tax policies, and lending practices can also create more opportunities for individual home ownership. But this requires voters to understand how current policies favor investors over families and demand changes that prioritize home ownership over investment returns. Supporting local builders and developers who focus on affordable housing for families, rather than luxury developments or institutional sales, can help create more homeownership opportunities, though this requires conscious consumer choices and community support. But individual and community actions alone won't solve the systemic problems created by housing finance. Restoring widespread homeownership requires policy changes that prioritize families over investors and communities over corporate profits. This means implementing taxes on institutional ownership of residential real estate, restricting foreign investment in domestic housing, and requiring that new developments prioritize sales to families over investors. It also means reforming zoning laws to allow more housing construction, changing lending practices to favor individual home buyers over institutional investors, and implementing policies that make homeownership financially accessible to working families. Most importantly, it means recognizing that the housing crisis isn't a natural disaster, while market failure is the predictable result of policies and practices designed to benefit investors at the expense of families. And it can be changed if enough Americans understand what's happening and demand better alternatives. The American dream of home ownership isn't dead because it's outdated or impractical. It's been deliberately killed by a system designed to transform Americans from property owners into permanent renters who pay tribute to corporate landlords. Your inability to buy a home isn't a personal failure or bad timing's the result of a rigged system that favors Wall Street firms over American families. The houses you can't afford to buy are often owned by investment companies that bought them specifically to prevent families like yours from building wealth through home ownership. But understanding how the system works is the first step toward changing it. The housing crisis isn't inevitably, it's engineered, and what's been engineered can be re-engineered to serve American families rather than corporate investors. The question is whether Americans will continue accepting a system that treats housing as a commodity for investor profits, or whether they'll demand policies that treat housing as a fundamental need and homeownership as a pathway to family wealth building. Your children's economic future depends on whether this generation will restore homeownership as an achievable goal for American families, or whether they'll inherit a rental economy where building wealth through property ownership becomes impossible for anyone except institutional investors. The choice is still yours, but only if you make it before the transformation becomes irreversible and homeownership becomes a privilege reserved for the wealthy. rather than an opportunity available to working families who are willing to save and work for their own peace. Of the American dream, the housing crisis is engineered to keep you renting forever. But it doesn't have to be permanent if you understand what's happening and choose to fight for a system that serves families rather than Wall Street firms.